Mohamed, it's very interesting to see how different central banks are responding to the same thing. What's your take?
My take, John, it really depends whether you're on the receiving end or whether you're the source of disruption. So if you're on the receiving end, you of course don't like it, and you hope that the source of this disruption is going to do something about it. If you're the source, which is the Federal Reserve, it's not clear what you do. Remember, this has been mainly a move in real yields. You don't want it to become also a problem on the inflation front. So the Fed is in a very difficult position. And I think the best thing they should do is actually do nothing.
That's what they have done so far, Mohamed. They've done nothing, and we've seen real yields continue to rip higher. Let's just reflect on what we saw in the last 24 hours, Mohamed. Would you consider that orderly or disorderly? Would you consider that mostly fundamental or largely technical?
So James Berry, someone I really respect, said, we came very close to a market accident yesterday. Put it in the context of the 4 risks I've been talking to you about for months now. Remember, the most likely risk was either a market accident and or disruptive yield curve dynamics. Yesterday, we got disruptive yield curve dynamics following the 7-year auction, increasing the probability of a market accident. We self-corrected, which is the good news, but the bad news, that's the second market accident we got close to in 2 months.
Define the potential for a market accident. What does that look like, Mohamed? Back in 2018, at the back end of 2018, we saw 100 basis points of high yield spread widening off the back of what many people considered at the time to be a Fed mistake. We haven't seen anything like that this time around. What do you think a market accident looks like?
So let me give you an image. In pursuing genuine economic objectives, the Fed provided the foundation for a whole building based on liquidity. And in the last few months, we've put more and more floors on that building. The Bitcoins, the GameStop, the SPACs, we just kept on building on the building. And the foundation is low yields. So if people question the foundation of that building, we will find out that the system has taken not too much interest rate risk, not too much credit risk, but too much liquidity risk. That is what we got close to. It happened at the end of January in the context of Robinhood. It happened yesterday in the bond market and after the 7-year yield. It is liquidity risk right now that...
Mohamed, you've got to add to that. Liquidity risk in the Treasury market where there should be liquidity. We're not talking about esoteric parts of fixed income in private markets. We're talking about in the Treasury market, there is a liquidity risk. You've got to build to that, Mohamed. How severe is that risk?
It's there, John. People woke up this morning and said the yield curve makes no sense. Look at the belly. Look at it makes no sense. It is there. It is serious, okay, but it's not clear how you fix it. That's the problem. Now, the good news is there are liability matching flows coming in that are self-correcting. That's why we're seeing lower yields this morning. But take the main message, which is we've got to be careful about liquidity risk.
Let's talk about another message that this market might be giving the Fed. I think it's interesting that we've brought in rate hike expectations, but inflation expectations have stayed the same over the last week, Mohamed. That goes against the Fed, is exactly what the Fed is telling us at the moment. Mohamed, why do you think that is? Why do you think that's happening?
So I wouldn't read too much in short-term signals. I think there is an issue about is there an inflation risk or not. You've heard me say there's a risk that the price level change will be a lot higher than what the Fed expects. But it's not going to be an inflationary process. The problem, John, is that if that happens, the market is not going to make that distinction. Economists and central bankers will. The market will not.
Mohamed, I want to get to a final word for you on the Federal Reserve and the events next week. I went through this earlier. Next week, on Monday, Williams is speaking. We'll hear from Bostic's Mester, Kashkari as well. Governor Brainerd speaking after that on Tuesday. We'll hear from Daly too, then Harker, then Evans. And then to close out the week before we get to payrolls, we'll hear from Fed Chair Jay Powell. Mohamed, are you expecting the script to remain the same?
So first, I hope that they'll all have common speaking points. The last thing we want is confusing signals. That's the first thing that's important. Secondly, I think the script will stay the same because there is no other script. Remember, the problem with relying for too long on monetary policy is that the exit becomes difficult, but at the same time, doing more becomes difficult. So they will stay with the same script, only because there is no other script right now.
Mohamed, final question for me then, final word from you. If you're looking at this market right now, what's the one thing you do?
I think you assess your liquidity risk, John. I cannot stress enough, it's not about credit, it's not about interest rate, it's about liquidity.
Mohamed, always great to catch up with you, sir. Good to see you.